Hi everybody, thanks for listening to our market update. This covers the events and news that happened from April through June. So after listening to this, you're going to understand why some funds are making money and why some of your funds are down. So what happened last quarter and how this affects your investments, I'm going to cover that with these topics. The Greek debt crisis, the U.S. economy, the Federal Reserve and the timing of rate hikes, profits and equity valuations, and global investing. So this is Europe, sovereign yields and fiscal austerity. The right hand of the page shows that, contrary to popular belief, Greece has actually pulled their deficit down by 9.5% over 3 years. Because of the austerity that's been imposed upon them by Europe, it's not difficult to believe why Greek voters voted no. Yet it's also not difficult to understand why the rest of Europe is reluctant to lend more money when they may not get it back. We believe that even if Greece does come up with a new proposal, Europe will decline. Recent volatility may be due to a fear that the situation in Greece might be contagious. In reality, it is likely not contagious, given the three possibilities: economic, financial, or political collapse. Greece is insignificant from an economic perspective. It's only 2% of the European GDP. The bailout program was designed to get Greek debt off the books of the European banks and onto the books of governments, which can handle the debt. This is economic growth in the composition of the GDP, or gross domestic product. While first quarter was weak, recent numbers suggest second quarter GDP may be around 3%. The right-hand side of the page shows a checklist of the economy. Looks like housing will be a big contributor. Investment spending data is mixed. It may slightly add to growth. Government spending will not add much, but there's some growth in construction spending, and consumption spending looks to be better than 3%. These are cyclical sectors. The left side covers auto and housing. The right side covers manufacturing inventories and capital goods orders. The left side, we're also seeing that elsewhere in the government data, it suggests there might be a problem with manufacturing inventories. So I'm keeping that in the back of my mind. Companies will need to work through this in order to stop distracting from growth. Growth is not picking up the way it used to, and with the American economy, it seems like this is the new normal. These are long-term drivers of economic growth. The right side of the page shows GDP growth over the last 6 decades broken down into growth in the number of workers and growth in the real output per worker. So we have averaged 3.8%, 3.5, 3.3, 3.1, and now 1.7%. Over the last 50 years, we've averaged 3.4%. Now all of that is gone. The bottom left-hand side shows that we're not doing enough investment spending, and that is taking away from productivity growth. The number of workers is going to quickly reduce growth in the labor force. The population demographics of people aged 16 to 64 shows that this is going to be even slower in the next decade. Think about it. A lot of the baby boomers are retiring, and that's less workers. So this shows unemployment and wages. It somewhat goes hand in hand with the last slide. The unemployment rate has fallen from 10% in October 2009 to 5.3% today. Wage growth is still very weak at 1.9%. Why have wages been so slow to pick up? Well, inflation is slow, so workers are not demanding higher wages. With less productivity growth, businesses are not inclined to supply wage increases. So will the unemployment rate, which is a brown line, and the wage growth, which is a blue line, move closer. If this is the case, then the Fed's criteria for tightening will be met. Also, if the dollar stabilizes and wage growth stabilizes, the Fed will be confident that we'll head toward 2% inflation. So this is the Fed and interest rates. The top line, it shows the Fed expects 1.9% growth this year, which I believe to be correct. They figure 2.6 next year. That sounds correct to me also. 2.3% in 2017 and 2.2% in the long run. From my research, this looks unlikely, but who knows? And we think it'll be closer to 1.5% until the baby boomers' retirement is complete. We think that we will have a rate hike in September and in December. So this is sources of S&P earnings. How are your investments going to earn some money? Because you're all invested in various companies, many which are with the S&P 500. So why were the first quarter earnings down? Simple answer is because of oil. Energy was clearly a big drag on earnings. We don't believe that the underlying earnings of the U.S. energy companies were actually negative. We stayed in utilities funds. They are down, but I do not think that's a permanent situation. We probably will see some pickup in earnings growth in the second quarter and the rest of the year, even if oil prices don't go up. On the dollar, 54% of the U.S. corporate revenues came from inside the U.S. That means 46 came from outside of the U.S. So on the right-hand side, you can see how much the dollar has gone up. This implies a big translation effect that's pushing down the value of foreign earnings. So here's energy, supply, demand, and prices. The bottom left-hand side of the page shows that the 2013 inventory fell, and in 2014 and 15 it's up and it will continue. We expect oil prices to be higher a year from now, and if oil prices increase, this will help corporate earnings. So the Iran deal complicates this, but if U.S. Congress approves a deal, Iranian oil will seep into the world markets over the next year. So trade in the U.S. dollar. This page reveals two things. One, the dollar's too high. Two, the long-run dollar will actually come down. The dollar's too high because we're running a big current account deficit. While oil may play a small part in that, the trade deficit will probably get worse. Europe, Japan, and emerging markets are all running current account surpluses. We are running a trade deficit because our assets are too expensive and everyone else's are too cheap. If your trade deficit is causing a demand for foreign currency, then it will tend to push the foreign currency up and our own currency down. So here's some valuation measures. Price-earning ratio, the forward price-earning ratio is currently 16.4, while it's averaged about 15.7 over the last 25 years. So we're slightly overvalued. Stocks still look cheap relative to yields that you can achieve from bonds, cash, or inflation. While we don't think the market's overvalued, we only expect single-digit returns going forward. So emerging markets and the economic snapshot. This shows the difference between emerging markets and domestic market growth and the ratio of emerging versus domestic markets. Emerging market stocks are underperforming relative to the developed country stocks. This is because the expectations of economic growth are falling in these, I'm going to call EM, or emerging market countries. Everyone seems very negative on EM, but the commodity cycle is coming close to bottom. China is growing more slowly, but India is growing very rapidly. Meanwhile, developed markets are running out of available workers. Unemployment is low in the U.S., and it's only 3.3 in Japan. Overall, the U.S. and Japan will grow more slowly, and the EMs will grow more quickly. Since the gap between EM and DM, domestic market, will widen, emerging market stocks will probably do well. Earnings are moving up in Europe as the economy improves, and there's a lot of opportunity in European stocks and some opportunity in Japanese stocks. These are asset class returns. Many of you have seen these at my office. If you look across the top, you can see the years 2000 through 2014. Then we have year to date. I'm going to skip the last 2 rows there. And what you're seeing is, for instance, in 2000, you can see the very top box says commodities. They did the best. And you roll your eyes down to the bottom, and you can see emerging market equities did the worst. So what you're seeing is each year in 2001, REITs did the best. And on the very bottom, you can see domestic equities did the worst. So it always shows you who did the best and who did the worst. You could see, for instance, in 2014, REITs did the best and commodities did the worst. And what you see in the middle with the grid line is a balanced portfolio that's never the best and never the worst. So the hardest part of my job is people will come in and say, why aren't I doing the best with everyone else? Well, you're never going to do the best and you're never going to do the worst if you have a diversified portfolio. And what we're shooting for is a smooth ride if we can. I can't control the market, so we diversify and try to get a little bit of everything. So what you could see here is the biggest distortion in the financial markets is the fact that cash is paying you zero. Central banks have made it so you can only make money through investing rather than saving. The global economy is doing okay, yet people are getting distracted by Greece. The U.S. economy is doing better, and valuations are not too high in the equity markets. So it's a good time for investors to take advantage of corrections and uncertainty and get invested in the long-term assets. It's especially true when short-term assets are paying zero. So thanks for listening. Please call us if you have any questions. I have a good quote I heard the other day for you that I'll end on. Rich people act poor, and poor people act rich. So good luck.